Welcome back to the Deep Dive. Today's briefing feels particularly important because the Bitcoin market, well, it's caught in this real tug of war.
It really is.
You've got these huge structural forces, like big institutions getting involved, pulling one way.
Yeah, the long-term view.
And then, bam, right in front of us, you have these immediate macroeconomic data tests pulling the other way. It's quite the setup.
Absolutely. That tension is, I think, the defining feature right now. The market's asking itself, do we focus on the big picture, the potential game changer like Vanguard possibly stepping in, or do we react to the immediate headlines like the potential U.S. shutdown, the jobs data coming out? It's a real conflict.
But it seems like, at least for the moment, the market's leaning one way.
The action recently suggests, yes, investors are prioritizing those long-term adoption stories over the short-term noise, at least for now.
Yeah.
We need to see if today's data changes that calculus.
Okay, so let's follow that institutional money trail first. The ETF flows saw a pretty dramatic turnaround.
Dramatic is the word, yeah.
U.S. spot Bitcoin ETFs pulled in a net $518 million just yesterday, September 29th. It's a big number, and it totally reverses the outflows we saw before.
It wasn't just a small positive number, it was a statement. And interestingly, a lot of that firepower came from one place.
Fidelity's FBTC, right? They led the pack.
They did. Nearly $300 million in net inflows just for FBTC. And look at the timing this happened, right as everyone's talking about the potential government shutdown. It tells you pretty clearly that institutional players were likely reacting to something bigger than Washington, D.C. drama.
And that something bigger seems to be the elephant in the room, or maybe soon entering the room, Vanguard.
Exactly. The reports are swirling. Vanguard Group, this giant asset manager, is apparently reviewing its stance. They might actually let their clients, 50 million clients, trade crypto ETFs.
Which is huge, considering how firmly anti-crypto they've been historically. A complete reversal, potentially.
It's arguably the major structural catalyst on the horizon right now. You can almost see the institutional money positioning ahead of any official announcement. It shows this adoption narrative is it's powerful. It's currently outweighing these transient political risks.
So if Vanguard does flip its policy, what's the real long-term impacts? So what?
Look, if Vanguard gives the green light, it fundamentally changes the conversation inside traditional finance. It's massive.
If so.
The debate in boardrooms, for wealth managers, for endowments, it stops being about, is Bitcoin even a legitimate asset? Should we touch this?
Right.
And it immediately becomes, okay, what's the right allocation size for Bitcoin in our portfolio? That shift, it just massively de-risks the asset class for a whole swath of conservative capital that's been sitting on the sidelines.
Okay, so that's the big, slow-moving force. Now, let's pivot to the immediate pressure cooker, the macro environment today. We've got this October 1st government shutdown deadline looming, but the market reaction seems muted, almost indifferent.
Yeah, muted is a good way to put it. It feels like the market's discounting it heavily, calling it more noise. And honestly, history kind of backs that up.
You mean looking back at previous shutdowns?
Exactly. The 2018-2019 shutdown, the market actually gained double digits during that period, and the 2013 one caused like a tiny dip, maximum 2.5% drawdown. So I think sophisticated investors see it mostly as political theater. It's temporary. Their real focus, their risk budget, is aimed squarely at the economic data that actually influences the Federal Reserve, and that's hitting today.
Right, 10 a.m. Eastern. Two key reports we're watching. First up, the JOLTS report for August.
Job openings.
Yep, the JOLT test data. Forecasts suggest we'll see job openings continue to drop from that previous 7.2 million number.
And why does that matter for Bitcoin, for risk assets?
Well, a cooling labor market, fewer job openings, that suggests inflationary pressures might be easing. That gives the Fed more room to be, let's say, less aggressive with interest rates, maybe even consider cuts sooner rather than later. So a weaker number could actually be good news for markets. Okay. Bad news is good news, potentially. But then there's the second report, the Consumer Confidence Index for September. And this one feels trickier.
It is trickier. The forecast is for a slight decline, down to 96.0 from 97.4. But there is a key level here.
Which is?
Historically, if that index drops below 80, that's often been a warning sign for a recession within about the next year. So this is where that tightrope walk you mentioned really comes into play.
Okay, break down that tightrope. What's the balancing act the market's trying to perform here?
So the market is kind of hoping for data that's weak, right? Weak enough to make the Fed think, okay, time to ease up, maybe cut rates. That's positive for assets like Bitcoin.
Got it.
But, and this is the crucial but, They don't want data that's too weak. So weak that it screams recession, because that could trigger a completely different reaction.
Like a flight to safety.
Exactly. A systemic run for the exits, everybody piling into cash or short-term government bonds, that would be bad for Bitcoin, bad for most risk assets. So today's data is a real test. How weak is too weak? Where's that line?
A delicate balance indeed. Okay, shifting gears slightly. Regulation. It's always part of the story, and we're seeing different approaches globally, aren't we?
Definitely a divergence. In the U.S., you had that recent SEC-CFTC roundtable. The signals there seem cautiously positive, a move towards maybe a more harmonized approach.
A less regulation by enforcement, which has been the complaint for a while.
Right. Commissioner Uyeda explicitly talked about avoiding duplicative regulatory costs. That kind of public commitment towards building a clearer framework instead of just lawsuits, that's generally seen as pro-business, pro-innovation. It helps de-risk things domestically.
But then you contrast that with what's happening in, say, South Korea.
Yeah, a completely different story there. The Financial Services Commission, the FSC, basically slammed the brakes on crypto lending services, halted them temporarily.
Why? What happened?
Well, they had this huge $1.1 billion market boom, but it apparently led to significant consumer harm. Something like 13% of users ended up facing forced liquidations. Ouch. So South Korea's crackdown is kind of a warning sign globally about the risks of unregulated high-leverage stuff, especially for retail users. It probably pushes regulators worldwide towards separating the market more clearly.
You mean like keeping the complex high-leverage products for the regulated institutions and guiding retail towards simpler spot products?
Exactly. That seems to be the direction things are heading. Okay, now let's tie this all back to the price chart. Bitcoin's price action has been active.
Yeah, we saw that surge, didn't we? Up to almost $115,000, testing that big multi-year trend line area.
Right. It hit a high of $114,866. So smack dab in that critical 114K to 115K zone, that was the big test.
And how did it go? Did it hold?
Well, it proved to be pretty tough resistance. The price couldn't sustain those highs, and it's pulled back since then. It even dipped briefly below the 50-day moving average, which is sitting around $113,000.
So what needs to happen now for the bulls?
For this upward move to really confirm the institutional optimism we talked about, Bitcoin needs to decisively reclaim that 114K, 115K area, turn that old resistance into new support.
And if it does?
If it manages that, the next hurdle is up near $118,000. And then, of course, the big psychological level at $120,000.
Okay, technical levels noted. Let's talk fundamentals underpinning all this, because ultimately utility and infrastructure growth are what support that long-term institutional thesis, right?
Absolutely. And we're seeing interesting developments like StarkNet launching this BTC-Fi initiative.
BTC-Fi, what's that about?
So StarkNet is a layer 2 scaling solution for Ethereum, but they're creating a way to use Bitcoin on their network, specifically a trustless method for staking wrapped Bitcoin like WBTC or TBTC to actually earn yield.
Earning yield on Bitcoin itself, not just holding it.
Exactly. And they're putting money behind it, allocating 100 million of their STRK tokens, worth maybe $12 million or so as incentives to get it going.
That feels significant. It shifts Bitcoin from just being digital gold, a passive store of value,
to potentially an active, productive asset.
Right. And think about that from the perspective of a corporate treasurer or an endowment. If you can generate yield on your Bitcoin holdings without taking on crazy counterparty risk, that makes the whole allocation argument much, much stronger. It feeds right back into that Vanguard narrative.
Interesting connection. We're also seeing maturation in the mining sector, particularly around energy use.
Yeah, that's been a big theme. Look at the partnership between Soluna Holdings and Canaan Inc. They're deploying 20 megawatts of mining capacity, about 1 exahash per second, at Soluna's wind-powered project in Texas, Project Dorothy.
So, using excess wind power.
Precisely. It showcases how the mining industry is becoming this specialized tool for monetizing what they call stranded assets renewable energy that the grid can't always use when it's produced. Bitcoin mining can just soak it up anywhere.
Making mining potentially greener and also helping renewables become more economical.
That's the idea. It helps drive down the cost to mine and makes North American mining, especially, a key part of the renewable energy puzzle. And meanwhile, some companies are still just steadily buying Bitcoin for their treasuries.
Yeah.
Hyperscale Data, for instance.
Yep, they're continuing to stack. Their position is up to $24.2 million now, and they've stated a goal of holding $100 million. So that corporate treasury angle is definitely still playing out.
Now, if we look under the hood, at the blockchain itself, on-chain data. What's that telling us?
Well, one interesting thing is seeing these really old dormant wallets waking up. We saw an example recently. A wallet that hadn't moved coins in 12 years suddenly moved 400 BTC.
Wow, that's like $44 million. In the past, wouldn't that have spooked the market? Fear of a big sell-off.
You'd think so, right? But what's remarkable now is the market reaction, or rather, the lack of one.
It just shrugged it off.
Pretty much. The market depth seems much greater now. These kinds of large, old coin movements are increasingly interpreted not as panic selling, but more like security upgrades, or maybe someone moving coins into custody, perhaps into those very ETFs we were discussing.
So it's seen as a sign of maturity, not fear.
Exactly. A sign the asset class is growing up, becoming more resilient.
But maturity doesn't eliminate all risks.
Hmm.
We have to talk about security, especially in light of this NPM supply chain attack that surfaced.
Yes, this is absolutely critical and frankly pretty scary. Malicious code was found injected into some widely used open source software components distributed via this thing called the NPM registry, which lots of developers use.
And what was the code designed to do?
Steal crypto,
Mhm.
specifically steal private keys, intercept transactions. It's a stark reminder that crypto security isn't just about the strength of the blockchain's cryptography itself.
It's also about everything we use to interact with the blockchain.
Precisely. The wallets, the browser extensions, the bridges between networks, the libraries developers build with the entire software supply chain. Its integrity is crucial, and this attack shows it can be a major vulnerability.
Okay, so let's try to synthesize all of this. We've got the powerful pull of institutional adoption, highlighted by the Vanguard potential and the ETF inflows. We've got the immediate test of macro data today. We've got evolving regulation, technical levels being tested, and fundamental growth alongside new security threats. Where does that leave us?
I think, boiling it down, the market's primary focus, its center of gravity right now, remains locked on that long-term structural adoption story. The Vanguard effect, whether real or anticipated, is casting a long shadow. It feels like that's setting the stage for the next big wave of capital potentially entering the space.
So the actionable takeaway then, for you listening, seems to be this. If we do see some price weakness today, maybe triggered by those jolts or consumer confidence numbers, long-term focused investors might actually see that not as a sell signal, but potentially as a strategic chance to accumulate, buying the dip, essentially, ahead of that larger structural shift they anticipate.
That makes sense in this context, which leads to maybe a final thought, something for you to chew on after we wrap up.
Go for it.
Okay, so we're seeing Bitcoin's utility expand, right? With things like Starknet's BTC-Fi encouraging people to actively use their Bitcoins, stake it, earn yield. This adds complexity, requires more software interaction.
All right.
Now, given what we just discussed about the NPM supply chain attack, how does this push for greater utility for yield generation fundamentally increase our reliance on the security of all that third-party software? Does it, in a way, shift the biggest security risk from the core blockchain itself to the interfaces and tools we use every single day to access it? Something to think about.